Okay, ladies and gentlemen, please welcome the first of our four competitors today, Cashflow Analytics. Welcome.
Good afternoon. My name is Mark Gagne. I'm President and CEO of Cashflow Analytics. Before I begin our presentation, I'd like to take a moment to thank the Georgia Research Alliance, the Technology Association of Georgia, and ATDC for inviting us to participate in this competition. We very much recognize the mission of these organizations, which is to foster economic development among technology-based companies in the state of Georgia. We appreciate the various initiatives and sponsorships that they provide to help entrepreneurs like Cashflow Analytics and our fellow competitors to grow, prosper, and be successful in today's ever-challenging and competitive business climate. When you talk about success, success starts with a team. I've been very fortunate in my career, which has spanned 25 years, 20 years of which as a C-level executive, to have built 5 companies, 3 of which I took public, most recognizable of which would be CMGI, which we grew from a $50 million market cap to over $3 billion. In all of those situations, we had great teams, just like Cashflow Analytics has a great team. First, we have Charles Mulford, or Dr. Charles Mulford. Chuck is on the accounting faculty at Georgia Tech. Been a professor there for 25 years. Chuck has won the Teacher of the Year award 14 times. He can no longer win the award because Chuck now has the award named after him. Chuck has written 4 books on financial statement analysis, giving significant insight and innovative research into how to better understand and look at the overall financial health of different companies. Chuck is a consultant to a number of commercial banks and members of the investment management community, including hedge funds, mutual funds, and managed funds. Chuck is also quoted 50 to 60 times per year by financial publications, including the Wall Street Journal, Barron's, Business Week, and Forbes. Dr. Eric Shorvitz is our CTO. Eric has his doctorate in economics from the University of Arizona. Eric began his career as a research analyst in the Advanced Strategies Group of Barclays Global, which is one of the 10 largest money managers in the world. Eric is a serial entrepreneur, having founded a number of technology-based companies. Eric is also an exceptional designer and developer of application software. Jonathan Clark is a research analyst with Cashflow Analytics. Jonathan is also a professor at Georgia Tech, professor of finance. He has his doctorate in finance from the University of Pittsburgh. Jonathan was instrumental in helping us develop our stock scoring model. And Mike Ely is a certified financial analyst and research analyst for Cashflow Analytics. Mike has spent his career analyzing financial statements and interpreting the value of companies. So who is Cashflow Analytics? Cashflow Analytics, very simply stated, is a company that helps investors make money. How do we do it? We provide a suite of software solutions that focus on quantitative and qualitative analysis of companies, identifying value so you can make money. Investing is not easy. People have 401k plans, I'm sure, or you have stockbrokers that recommend stocks, or you have relatives that recommend stocks. What it comes down to is, am I going to buy or am I going to sell? And when am I going to buy or am I going to sell? It's a combination of a lot of information that you need to evaluate and analyze to decide whether or not to buy a stock or sell a stock. It may be as simple as its market capitalization. It may be its revenue growth. It may be its PE. But again, investing is not easy. I always get concerned when a friend of mine will say, this stock is dirt cheap. Or they may say, this is a 10-bagger. First thing that comes to mind for me is, what do they know that I don't know? And why? And is what they know right? And that leads us to the market problem. Everyone reports the same information, and unfortunately the information isn't always right. Now, I don't know about you, but I hate it when I get the wrong information. I mean, if you're driving down the road and you stop for directions, and I do stop for directions, and you get to the stop sign and take a right when you should have taken a left, it may cost you 20 minutes of time. But if somebody gives you publicly available information and gives you financial reports that you believe you can rely upon, and they're not right, it may cost you $20,000. And that's what's critical when it comes to understanding information reporting. You have 3 key financial statements. You have the balance sheet, you have the income statement, and you have the cash flow statement. We focus on all three of those statements. And one of the things that we've learned is there's a lot of subjective methodology around those statements. You will have the big four CPA firms report the exact same transaction differently. You will have public company CFOs give you information that is incorrect either out of ignorance or creative accounting. You will get financial statements that don't provide you the in-depth, comprehensive analytics, the metrics, the information that matters to make an educated, informed decision when it comes to buying a stock. That's what cash flow analytics gives you. And then from there, after you get the information that you know is correct, you need to be able to forecast the future value of that company. And that's where we come into play. Our solutions, our suite of solutions, are very robust tools that enable you to look at our proprietary methodologies, to look at metrics that matter, predictive metrics, metrics that you know that if this is a value, odds are very high that you'll get this value in the future. Highly predictive metrics. They enable you as an investor to do an intelligent analysis before you buy or sell a stock. They enable you to drill down and understand the numbers, to look at a company's overall financial health as well as its sustainable financial performance in the future. From these tools, we developed a stock scoring model. Our stock scoring model includes 10 years of back-tested data where we looked at over 6,000 public companies and we rated them on a simple scale, 0 to 7. You buy the 6s and 7s, you sell the 0s and 1s. The 6s and 7s outperformed the market by 10% per year over a 10-year period, utilizing our metrics, utilizing our proprietary metrics. The 0s and 1s underperformed the market, which you would sell short, by 10 to 19% per year. Next came our alpha signals. Alpha signals weren't even on our product roadmap. We had a prospect say to us, you know what, we really like your stock scoring model. We like to take an element of that, and we'd like to back test it and see how it would do in our own quantitative strategies model. So they took our free cash flow, free cash margin, which is one signal in our stock scoring model. They went back. This is a London-based firm. We just got the results this week. They went back and they back tested our numbers versus reported operating cash flow. They found 60 basis points of alpha. That may not sound like much. They've got a $5 billion portfolio. 60 basis points of alpha is $30 million of investment return for them on an annual basis. It's considerable. Next, our research spotlights. We wanted to show our clients that what we profess really is true. So we started creating research spotlights to show them how to analyze different companies, how to drill down with the numbers and understand the future value of a company. Now we've got clients that have said, why don't you write research spotlights and we'll pay you a subscription fee for those. So we've done that. And I'll tell you about one later, which was Westinghouse Air and Brake, that we wrote about 40 days ago. So when you think about cash flow analytics and you think about our intellectual property, it's a combination of technology, the ability to deliver it quickly, to make timely decisions for investment with with knowledge, with thought leadership. That thought leadership comes from my partner and our managing director of research, Chuck Mulford. Chuck wrote this book, which is Financial Warnings, in 1996. Financial Warnings focuses on earnings management. Earnings management that you would see if you went back in time and looked at GE as a great example under Jack Welch's tutelage. Financial Warnings talks about public CEOs and public CFOs managing earnings so they look great, so that the stock price will move well. In 1996, Chuck wrote the book. In 1998, the SEC acknowledged that earnings management is a problem. In 2001, Chuck Mulford, again, great thought leadership, wrote the book, The Financial Numbers Game. 2 weeks after this book was written, the Enron scandal occurred. So again, Chuck saw that people play with numbers, that fraud is created in financial statements. Just as Enron created fraud, Chuck highlighted the fraud in here. Coincidentally, this book outsold Harry Potter for a day. And Chuck's most recent book, Creative Cash Flow Reporting, when analysts and investors decided I can't rely on the earnings statement anymore because I know those numbers get played with, I know I can rely on the cash flow statement because cash is king. You can't play with cash. It's on the balance sheet. It's got to be correct. Chuck came out with creative cash flow reporting, where you also find numerous differences in the cash flow statement among your public company CFOs, among your big four CPA firm, and how they treat and they analyze the numbers. A big part of what we do is standardize our data so we report all the numbers the same. We want to drill down and understand the numbers so we can understand the value of a company. So who's the market? Market's people who manage money. It's an immense market. The global fund management industry is $55 trillion. In the domestic U.S., there's over 8,000 hedge funds that manage over $1 trillion. There's over 9,000 mutual funds that manage over $3 trillion. And there's over 10,000 registered investment advisors who manage over $5 trillion. So what matters to a money manager? Fiduciary responsibility. That just adds up to, am I giving the right advice? Do I have the right information when I recommend to a client, buy this stock? And unfortunately, the numbers aren't always right. And if you drill down, you can find that they're not. In November of last year, November 2006, Sanjay Kumar, former CEO of Computer Associates, was indicted and got 12 years in prison for a $2.2 billion accounting fraud that was committed in 1999 and 2000. They played with revenue recognition. They played with the numbers. They wanted to meet market expectations. Interestingly, if you take Value Analyzer, our product, and go back and look at those numbers, you very quickly see that the earnings were suspect because the cash flow wasn't there. So if you're a money manager and you know your responsibility is to recommend stocks that you've done your diligence on, you want to use Value Analyzer to make sure that the stock numbers are true. Who's our competition? Our competition is other data service providers, information service providers. Those information service providers give you the SEC reported financial information. They give you GAAP-based financials that we already know have subjectivity to them. They give you research spotlights or research recommendations. They focus on the past. Cash flow analytics focuses on the future. We recognize that our clients, that you as investors, want to know what the future value of a company is. You don't want yesterday's box score. You want tomorrow's. And that's where our focus is. None of our competitors have a forecasting engine that enables you to drill down with 200-plus line items to forecast and predict a balance sheet, an income statement, and a cash flow statement, to drill down and see valuation metrics that you can compare to a competitor to see how they are from a relative value standpoint or relative to the market. None of our competitors have our proprietary predictive metrics. Predictive being the key word, the ability to predict future value that we have back-tested through our stock scoring model. None of them have our stock scoring model. Again, the ability to go through and rate a stock and see how it will do. So our business model is fairly simple. It's web-based. You have a user ID, you have a password. You dial in, you identify stocks, and you make money. It's that simple. We utilize open source technologies because we want to minimize our total cost of ownership. Our model is a subscription-based pay in advance model. So cash is really king for us because we don't have receivables. We have a high incremental profit margin. The great thing about software is you can sell it and you make a substantial profit on it. $1 of revenue for us is 90 cents in profits. Our target market is immense. Money managers spend billions, yes, billions of dollars each year on innovative research solutions. Solutions that they believe they can rely upon. Solutions that provide thought leadership, like Chuck Mulford's thought leadership in his books, where he saw the future 3 different times in 3 different books. We recognize, we just got back from the NYSSA CFA conference in New York. 1,500 money managers were there. One of the big demands they kept saying to us was, this would be great if you could do it internationally. So part of our business model is to expand to include international companies, as well as financial services firms. Our sales strategy, go to where the pain is. So if you go to a money manager, you have to understand, what do they want? Well, fiduciary responsibility is big. You can lose a client. Recommend one bad stock. Have a great track record 99 times, but not do your diligence, not drill down, not see that Enron, not see that computer associates. You'll lose a client. So we drill down on the capabilities of our value analyzer. We focus on our innovative solutions and our stock scoring model and the ability to pick stocks that we know win. Our target market includes hedge funds, managed funds, mutual funds. Our pricing is very much value-based. It's $4,000 per month for 2 users to use Value Analyzer and use our stock scoring model. Our research spotlights have one of the highest ROIs that a money manager could want. Example would be Westinghouse Air and Brake Technologies. We wrote a report on them April 13th. The stock price was at $33.92. It was rated a 6. We said it was a buy. It is now 41 days later. That stock is over $39. That stock has better than a 15% return in 41 days. If you invested $1 million or $2 million, you made between $150,000 and $300,000 on a $4,000 research bill. And what I forgot to mention was we also recommended Applied Integrated Technologies, and we recommended Ceragon Networks. Ceragon Networks in 3 weeks is up 21%. Applied Integrated Technology is up 13%. Our financial forecast, very much revenue top-line driven, based upon, we're looking at $1.7 million in revenue this year, based upon our current backlog of customers and what we've got from prospects from the show and from some other shows. If we close 28% of our prospects, we'll meet our top-line revenue number. We expected to lose $700,000 this year. Like any business, you're constantly evolving your business plan. We're evolving ours. We went to the show in New York. Now we've decided we need to push forward on our product roadmap. We need to get international companies quicker. We need to get financial services firms quicker. We need to move that roadmap. We need to add people. We need to drive our sales and marketing plan quicker. So right now, when we look at our needs, we need somewhere between $2 and $3 million to continue to drive our company forward. So that's the funding that we're looking for. Operating highlights. Version 1 of Value Analyzer came out in July of 2005. In August of 2005, Shapiro Capital, right here in Atlanta, a $1 billion-plus money management firm, became a client. And they're still a happy client today. We came out with version 2 of Value Analyzer in June of 2006. Again, we expanded our capabilities. We got into a comparison engine, a screening engine, custom alert, a number of features that our customers gave us feedback on that they wanted. So we continue to expand the product. In January of this past year, we came out with a stock scoring model, again, to rate stocks. Our future expectations are to be profitable on a monthly basis by December, as long as we continue to invest in sales and marketing and drive our plan. 2007 and 2008, we're going to expand our development efforts, which I already mentioned. And in 2008, we want to open a UK office because we believe there's significant demand or client demand of money managers in the European community. So when you think about cash flow analytics, think about innovative, proprietary solutions. Think about thought leadership that came from co-authored books by Dr. Mulford. Think about a significant target market of billions of dollars being spent every year on innovative research solution. Think about that recurring revenue stream, because once they've seen you can do it, they continue to use you. But more than that, think about an experienced and dedicated management team. Think about 3 PhDs, 3 CPAs, 1 CFA, and 1 MBA. A lot of thought leadership. A team that recognizes that our clients' needs come first. A team that recognizes that it's important to help our clients identify investment solutions that will enable them to make money. I'd like to bring up my partners who helped me found this company and build it, Dr. Charles Mulford and Eric Shorvitz. Thank you.
You made it. Congratulations.
Hey, thank you.
Mark, nice job. All right, we'll turn it over to our judges to ask the tough questions and get, as Paul Harvey would say, the rest of the story. Who's the first? Scott, go right ahead.
Mark, do you own the intellectual property rights on your analysis methodology?
When you say we own it, all of it's been developed within the company based on Chuck's books. So it'd be Chuck's books and everything we've developed technology-wise internally.
A little unclear exactly how I use your tool as a user. If I've got a basket of stocks I'm interested in, Do I have to input all the data related to that company to get the output? How do I interact with your system if I'm paying you $4,000 a month?
We get data on a daily basis, actually intraday data from a data provider, which is CompuStat. All you have to do is take Westinghouse here and break. You go to our reports engine, type in WAB, select 1 year or 10 years of data. Your reports are generated in a second and a half, 2 seconds online in front of you. You've also got automatic defaults built into your preferences section that enable you to forecast 1 year, 2 year, 3 year, 5 year, whatever you'd want forward based upon various criteria.
So you've done all the data collection on how many stocks that are out there, and all that information's already included in your back end, and I just basically am doing reports on it?
You're able to run reports because what we've done is we've mapped all the data from CompuStat. So we map it into our standardized financial reporting with all of our comprehensive analytics and metrics. I mean, you could go to our metrics page as an example, which scores stocks, and you would see over 90 different comprehensive analytics to be able to evaluate a company. Or you could go to the reports page, and you could generate a 250-page report with as much detail as you wanted, because it got very robust ad hoc reporting, and get whatever detail you wanted on those financial statements. They're extremely granular, and that's where we know we provide the information that matters, because you can identify danger signals that may occur with a stock. You can look at anomalies and trends in areas that don't make sense, and we're drilling down in every line item of the financials to do that.
Dr. Glasser.
What impact, if any, would a shift by the SEC to XBRL from the current reporting and the Edgar system have on your model, on your business model?
You want to take that?
Sure. Currently, the data that we receive from CompuStat is a flat file feed that we bring into our back-end database. So right now we're working with the CompuStat flat file system. The new systems that are going to come into place, we will just continue to get our raw data through CompuStat, which is a Standard & Poor's company. So at the end of the day, the change of the data reporting type is not going to have an impact on our ability to move forward.
Jake?
Yes, I see you. Forecast, financial forecast. Can you share the past 12 months, 18 months of actuals?
I think it's important when we talk about 12 months and 18 months. I just sold the company and had to integrate that company and help integrate it, and I left that company in January. Chuck is a professor at Georgia Tech. Eric left the company. He's also running another technology company. When I left the company in January, we decided we would come together and dedicate to building this. So we've sort of built this company part-time. So in terms of customers that we've closed, it's been people he's consulted with, people I've known. So the ramp rate of that, since we came on board, has been very good. Prior to that, we weren't dedicated to it.
The solution is tested. Are there a dozen, 2 dozen customers who are actually using it before you make the big launch?
There's several customers. We have several customers using it right now, names that you would recognize, some of which we can't disclose because of contracts. But we have several customers using it, and several prospects that came from the show that we were just at.
Paul?
To follow up, Mark, on the question earlier about the data that is compiled, I'm still a little confused. There's a significant number of public companies between NASDAQ and NYSE and other markets. So you are actually compiling all the information, performing your analytics on those companies. So if I'm a user, I just pull up the end result, and you follow every company, basically?
That would be correct, except for financial services firms. Our database that we currently have is non-financial companies, which means we don't do banks, we don't do insurance companies. That's one of our future product roadmaps in terms of financial services firms. There's a lot more subjectivity in financial reporting of those firms. If you look at an insurance company, it may be mark-to-market issues. If you look at a bank, you may want to look closely at a loan loss reserve analysis. So how we're going to report those is something that we're working on, and hopefully will be done in the next 3 to 6 months.
Is there any one type, that's a good follow-on, is there any one type of industry, because of the dynamics of that industry, that particularly lends itself to particularly accurate forecasting for your product that you could think of?
Particularly, when you say particularly accurate forecasting, I guess I'm going to break that out into two pieces. If you look,
This is a real softball. You should take
no,
advantage
no,
of
that's
it.
okay. When you look at our stock scoring model, it works very effectively with companies in a market cap of $3 billion and under. We found, and that's why we're getting significant abnormal returns. When you look at running a report, I think our forecasting capability is very rich for any one of those because you've got a deep and granular level of historical information to build upon going forward. You've also got all of your competitor information right there at the site too. So again, so I think any industry outside of financial services firm, we do a great job at forecasting. And in the same vein, when you're looking at a stock scoring model, stocks that are in $3 billion and under are the ones that we best project.
Alan Mosley, you got a hardball?
I don't know how hard it is. We'll see. Mark, you talk about the competition, and there are a number of large hedge funds out there and small hedge funds, and I would say many of them believe they have proprietary analytic tools, that they would argue they have forecasting engines and ways to get into proprietary metrics. In fact, I think that's what many hedge funds sell themselves on. So who are your competitors? You only listed a few names here, and wouldn't you say that when you go call on some of the larger hedge funds that there are lots of in-house proprietary tools, many of which are designed by teams of brilliant engineers like my colleague here from IIT. I've seen the rooms full of these people, and they're off doing their own thing. So what is the competition, and do you think that will be a challenge as you sell to some of those potential customers?
The competition, I mean, internal, you mentioned internal, and everyone does have different internal tools they've developed. What we've found is that typically our solutions, in terms of using the solutions, they haven't really developed technological solutions anywhere near ours. I hate to say it like that, but I mean, I give the example of a client that I mentioned earlier where we went in and they weren't using a data provider. So when they chose our tool, here you are managing over $1 billion, and they had data that they used, but not with the deep analytics that our tools provided. And to second that, all funds are looking for alpha. All funds are looking for ways to generate abnormal or excess returns. So if you've got the ability, as we do, based on 25 plus years of research, to deliver alpha, they're more than happy to subscribe to you. I mean, we're in conversations, as an example now, with a fund that manages over $110 billion. They've read the white paper that Chuck wrote with Jonathan Clark and all the back testing that was done, and are extremely intrigued by it. We've already had at-length conference calls with them about how they can incorporate our free cash margin and other signals into their quant model. So all funds are looking for alpha. So they're looking for people who can provide thought leadership, who can help them get that additional return. All funds are also looking for, as I mentioned earlier, the fiduciary aspect. You don't want to be in a situation where you're recommending a company based on numbers that aren't right. And, why don't you could, and Chuck, I don't want to put you on the spot, but we can mention that auto company that you wrote about, if you got a moment.
He's just mentioning, it was a report, this was when I was writing reports and looking at companies, and just wrote a report how one of the large automakers was misreporting cash flow by $4 billion. And, while it was argued that they were doing it correctly, or so they thought, I thought they were doing it incorrectly, and it wasn't more than about 9 months later that the SEC, in fact, made them restate their cash flow statement and subtract $4 billion out of operating cash flow. Now, this was a major U.S. manufacturer of autos, and they have big staff and lots of people there, and, it's things that we think we can see that they're not seeing, and we think we do add value. So we're not intimidated when somebody has a large staff of, very smart people. We are looking at things differently, and when you demonstrate that you can add value, they're more than happy. Plus, when you think of the numbers of potential places where this data can be sold, you can see that a little competition, there's still plenty of this business to go around.
Stuart.
If I may stay with you, Dr. Mulford.
Sure.
You realize that the value proposition of your company is controversial because there are many schools of economic thought, of research, that say all information all publicly available information is already priced into the stock because of the efficiency of the market. Now, even in your most recent example, interpretation of financials is one thing, but that information is publicly available, and there's a lot of independent thought and decades of research would suggest over the long haul, particularly not necessarily isolated situations, but over the long haul, the efficiency of the market is such that's fully valued. It's fully incorporated into a stock.
Companies, obviously, timing's important, and when it comes to preliminary data, let's take Home Depot's release of earnings just recently. They didn't release a cash flow statement in their quarterly numbers. They just released a balance sheet and income statement. We're able to produce cash flow numbers within minutes of when they release these preliminary numbers, and it becomes available to our users. Okay, so we mentioned this one company in London that's backtesting our numbers. They found that we're providing alpha within, for 2 or 3 days following our numbers, because that data is generally not available for others to use. So we think there is, I totally believe in an efficient market, okay? But the whole thing is, can I get information early? And then when I start to think about the international market, where the reporting is much less than what we have here, many companies there don't even provide cash flow statements. And so we're able to generate cash flow statements in the absence of that reported information. We think that's going to be a very lucrative market for us, too.
Tom.
Back to the previous question on competition, the money management universe is highly fragmented. So what is your sales and distribution methodology going to be to try to reach such a diverse audience?
Well, distribution is an easy answer because it's going to be web-based. Everything is a web-based distribution of the product. In terms of sales, it's a direct sales force model. Let's say sales in marketing is probably a better way to phrase it. Sales will be a direct sales force, 5 regions, which is the East, the Midwest, the Southeast, and the West, as well as Canada. In terms of it, market awareness or creating awareness about our company is one of our biggest challenges now. When we were at the NYSSA conference, which is the New York Society of Securities Analysts, Certified Financial Analyst Conference in New York, one of the common comments we got was, "This is great. How come I've never heard of you guys?" So market awareness and creation for us is important. So a lot of that will be going to the different state societies or different city societies of securities analysts, going to Baltimore, going to Boston, going to New York, going to the different societies, getting our name out, which was a big part of why we wanted to be involved in this competition. For the market exposure, we saw the benefits. And so for us, it's getting our name out. It's going to be press to flesh. We found that already, to get in front of people so they can see that we know what we're talking about, that they can see, both through our research reports and our tools and our metrics, that they are highly predictive, that we do enable you to find and identify stocks that you can profit from. And our research reports have shown that. I mean, I mentioned earlier the last 3 that we've written, they are up 21%, 15%, and 12% in a period of less than 40 days. Because we drilled down with our metrics that we know are highly predictive. We did our forward forecasting with our engines and found these were stocks that were undervalued in the market.
Pete?
Question, if you don't mind. You're basing most of your analysis on publicly available information, CompuStat and so forth, so it, like the rest of the world, is subject to the gamesmanship with financial reporting. I'm assuming from your comments that you have done some analysis that will tell you if certain metrics are aligned differently in the current period than historical periods. Those are warning signals and so forth. And if cash flow is diverging from earnings, those are the types of things that set off signals. My question for you, though, is suggesting that you have some initial success. What is it about your model that won't be easily copied by others who take a look at your 3 examples in the last 21, 31 days? The companies you've picked are up substantially greater than the market. There must be some simple approach to identifying what they've used to determine that they should be up more than the market. Are there more than 1, 20? What proprietary sustainable competitive advantage have you developed that won't be easily replicated by other brilliant people?
You want that?
Thinking on this is always evolving, and we need to stay ahead. We understand that. The model, we worked on this thing for over a year, nights, weekends, developing this. There's nothing in here that is apparent to just a casual review to identify, well, why did this cash flow number do this? So we don't take the numbers, as given. We reconstruct all the financial statements from scratch to create our own, okay? And so it's not as, it cannot be replicated as easy as you might think. A lot goes into it. And like I said, we're not standing still. I mean, if you look at what was written in these books, you're always working on the next thing, and that's the only way to stay alive. So we think we're going to have, a great start. We think we have a great opportunity on the international stage where, there's less competition for investment ideas and that kind of thing, but we're then always working on and moving ahead.
Got enough time for one more question. Dr. Glassman?
Is the value that potential customers will perceive in the score, the 6 and 7 versus the 1 and 2, or in all of the reports that they get?
It's everything like that. We find some users of our data want to dig down and use the forecasting engine and forecast out several years with in-depth statements. Others just want the score. Tell me what I should buy, what I should sell. Others want, as we said, these alpha. They want the data that goes into the score. So we're finding that while it started out as an in-depth analysis tool, and then the score came, and now we have the alpha with the inputs that go into that, and then we have where we write our own research. We find people are either taking it all or using it a la carte. So we're trying to fill a need that we find.
Just to add to that for a moment, I mean, we have a good example of that will be a client we have in Portland, Maine. I mean, they follow the reports and generate reports every week, detailed reports. He's got them set up by files and folders, by sectors, and a lot of deep analysis around the reports. Whereas we'll have other ones that just want to read the research spotlight and say, okay, this sounds like an opportunity. So you have some clients that want to do the work, want to really dig in as an equity analyst and dive into the numbers themselves. Then you have other ones who, I don't want to say are lazy, but you have other clients that just want to take a research report and say, okay, this looks great, looks like a buy recommendation, I see why, I'm going to buy it. So you have a broad spectrum of clients in terms of what our products and services provide.
Gentlemen, thank you. Cash Flow Analytics, the first company in our 2007 GRA TAG business launch competition. We'll let our judges take notes, make their comments in their books, and come back in a few minutes, top of the hour, in fact, with the second of our 4 companies. We'll see you in a minute.